Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Sundial stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Sundial operates in all three segments of the cannabis market: the upstream, which is the cultivation part, the midstream, which is the manufacturing of cannabis, and the downstream, which is the retail sales. It produces and distributes marijuana flowers, pre-rolls, and vapes. It cultivates cannabis using an individualized room approach in a warehouse 500,000 square feet. It has supply agreements with 9 Canadian provinces and has a distribution market that covers 98% of the Canadian recreational cannabis market. It is Canada's largest cannabis retailer with 180 locations. The company recently acquired Cannabis, which operates 71 stores. Sundial sells cannabis in all price ranges, from premium products down to discounted products. This year, it acquired Alcanna for $346 million in an all-stock deal. Alcanna operates 171 liquor stores. It trades on the TSX under ticker CLIQ. Its market cap is $300 million. And its trailing 12-month revenue is $700 million. The main reason Sundial acquired Alcanna was because Alcanna owns 63% of Nova. Nova operates 71 cannabis retail stores. Nova trades on the TSX under ticker NOVC. Its market cap is $215 million, and its trailing 12-month revenue is $62 million. Cannabis is legal on the federal level in Canada since 2018. It is completely legal in 18 US states and legal for medical use in 37 states, but illegal on the federal level. Legalizing cannabis at the federal level would allow Sundial and its Canadian peers to enter the more lucrative US market. The company is headquartered in Calgary, Alberta, Canada, and was founded in 2006. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a small cap company, 1.4 billion market cap. They're trading at 68 cents a share, and they have 2.1 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow every single year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every single year. Revenue is a sales for the company, and that went from 0 to 60 million, but has been dropping from 48 million down to 37 million. This is the company's income statement from Yahoo Finance. In a little bit, we're going to look at their income statement from their most recent quarterly report. All their financials are in Canadian dollars. I converted them to US dollars since we're looking at the ticker that trades in the US. The top line is the revenue, the sales. In the company's quarterly report, they mentioned the government has the right to return product or even get a price adjustment. Also, some licensed producers have the right to return the product if it's within the warranty period. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was a big negative in 2020. Let's look at their annual report to get some more information on their gross profit. Here's a breakdown of their 2019 and 2020 gross profit. They give us gross revenue, then excise taxes, then net revenue. Excise taxes are an additional tax. You'll also find them on tobacco, alcohol, gas. They had 52 million of cost of sales in 2020. This is cost of labor and cost of products. Inventory obsolescence has been pretty common with cannabis companies lately. These companies are growing so much weed and they're not able to sell it all, so it's going bad and they have to throw some away. And they had to do an additional $19 million write-down of inventory. That's a company's projected future inventory obsolescence. So this is really killing their margins, growing so much marijuana. They wrote down 11 million of inventory in 2019, but that's a lot less than the bad inventory they passed through of 46 million. So this is something to keep an eye on because these losses affect you, the investor. Below that is their operating expenses and then their operating income, which is negative every single year. They got rid of most of their debt. They only paid 1.9 million of interest on their debt in the trailing 12 months. They paid 21 million in 2019, 9 million in 2020. But they've been raising lots of equity, so they've been using that equity to pay down debt. And they've been passing through lots of write-downs. As you can see here, 181 million in the trailing 12 months. That's why their net income looks so terrible. But I would usually focus on operating income when I look at the income statement, not net income. Because net income can be artificially low due to all the write-downs. This is their operating income from the third quarter of 2020 to the third quarter of 2021. Their revenue did go up from 13 million to 14 million, but they're passing through these large investment losses of 18 million. I believe this is their investment in other cannabis companies. Since most cannabis stocks have been decreasing, so has been their investment in those companies. So they reported a loss of 19 million in the third quarter of 2021, which is better than an $89 million loss in the third quarter of 2020. But that's mainly due to an asset impairment. If it wasn't for the asset impairment, their loss wouldn't be that high. This is the statement of cash flows from Yahoo Finance. In a little bit, we're going to look at their cash flows from their quarterly report. The top line is operating cash flow. That's how much cash the company loses from its operational business. So you can see they lose cash flow every single year, and it's getting worse. Negative 173 million in the trailing 12 months. They don't spend too much money in CapEx. They spent the most in 2019. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow every year, they need money from somewhere to fund their operations. So they're doing it mainly with stock. They issued 177 million in 2019, 181 million in 2020. Then 1.2 billion in the trailing 12 months. Every time a company issues stock, it dilutes the current shareholders, making your shares less valuable. They pay down most of their debt by issuing all that stock. This is their cash flow from operations section from the third quarter of 2021 versus the third quarter of 2020. And the way you calculate CFO, you start with net income or net loss. They actually had a net income in the third quarter of $11 million. And to calculate CFO, you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So it looks like they got a tax credit for $10 million, so we have to minus that out on the statement of cash flows. We have to add 3.4 million of depreciation. We have to add 3.9 million of inventory obsolescence, because that's a non-cash item. They spent the cash when they initially bought the inventory. When they can't sell the inventory or the inventory goes bad, they just write it off. They passed through an unrealized loss of 24 million on marketable securities. Since it's unrealized, there's no cash transaction, so we have to add that back here. And it looks like they bought 46 million of marketable securities. If this was a US company, this would be on cash flow from investing section, not the cash flow from operations section. It's odd to see such big swings in marketable securities. You generally wouldn't have such a big unrealized loss or gain. Usually marketable securities don't move too much. They tend to be really liquid, like T-bonds, commercial paper. They offer really low interest rates, so they barely move. Maybe in Canada, marketable securities has a different definition. Even though they reported an $11 million gain in the third quarter, they actually leaked 56 million of cash flow from their operational business. The top half of this chart is the investing cash flows, and the bottom part is the financing cash flows. And it's also showing the third quarter of 2021 versus the third quarter of 2020. The first line in the investing section is the investments in PP&E, property, plant, and equipment, or CapEx. And it was around $1.1 million in both quarters. And they had a $135 million cash loss on investments in equity interests. This is their investments in other companies. Equity method accounting is usually used when a company owns between 10 and 50% of another company. So they have significant control, but they don't own more than half the company, so they cannot consolidate the financials on a balance sheet. So they have to report their earnings as equity interest. This is not much of a surprise because cannabis stocks have been really struggling the past few months. So they lost 135 million from their investments in those companies, just in the third quarter of 2021. And it looks like they acquired a company for 84 million of cash. And this could be one company or multiple companies. And the acquisition could have been part cash and part stock, so this could be only part of the acquisition price. But the statement of cash flows only tracks cash. On the cash flow from financing section, it looks like they had an inflow of 19 million from restricted cash, an outflow of 9 million from convertible debentures, they issued convertible debt, and since that debt didn't convert to equity, they have to pay off the debt holders. So they had a cash inflow of $12 million from financing activities. This is the equity section of their balance sheet. They have $1.4 billion of equity. They raised $2 billion from selling their business, and they lost $700 million from running their business. So it's not good to see a big loss, but they do have a lot of cash to work with. Hopefully at one point they'll become profitable and turn this accumulated deficit into an accumulated profit. And the $62 million of contributed surplus, this must be preferred shareholders. They received $8 million from warrant sales. Let's look at the capital structure. They have $1.1 billion of equity, $19 million of debt. They're 98% equity, 2% debt. And they have a lot of cash on their balance sheet, as you can see, net debt of negative $577 million. And I gave them the average WACC of Simply Wall Street and the lowest WACC on Finbox, 7.73%. And that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $4.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.6 billion. We divide that by 2 billion shares. And we get a calculated stock price of $124. They're trading at 68 cents, so they're trading at a 45% discount. It's a buy according to the model. The average analyst projects their revenue to grow 61%. I grew their revenue 61% for the next 7 years. That's how I got their future revenue estimates. And I figured they'd be cash flow positive by 2023. So I just multiplied their revenue by 5% in 2023 and 2024 to get their future free cash flows. And to get their future cash flow, so 25, 26, and 27, I multiplied their revenue by 10%. The average company converts 10% of their revenue to free cash flow. So it's definitely not a slam dunk. This stock has really struggled, and there's a lot of competition. Plus, the US has not approved cannabis on a federal level. If that happens, this company should start doing a lot better. But you have to realize, if that does happen, then there's going to be a lot more cannabis companies popping up. The last time I did a video on this stock was back in February. The stock price was $208. My valuation was $137. So the stock has come down well below $137. Just because something is overvalued doesn't mean you should not buy it. And just because something is undervalued doesn't mean you should buy it. Let me give you an example. Say your budget for buying a new car is $30,000. If a Jaguar was usually selling for $200,000, but it's on sale for $150,000, that does not mean you have to buy it because it's selling at a discount. You just don't see the value of paying $150,000 for a car, even though you know it's worth $200,000. For another example, say your neighbor wanted to sell you his car because he knew you were looking for a car. The Kelly Blue Book value for his car is $10,000. But you don't like his car, you think it's ugly, and he's willing to sell it to you for $7,000, 30% off the Kelly Blue Book value. Same thing, just because he's giving you a discount on the price doesn't mean you have to buy it. It's with a stock too, just because it's trading at a discount doesn't mean you have to buy it, because nobody can predict the future of a stock. There's no guarantee it's going to hit $1, $2, $3. It may hit that level, and if you're really bullish on this stock, then definitely buy it. But if you're not that comfortable with it, there's no reason to buy it if you're not sure. Simply Wall Street is on a different planet. They're at $6 a share, their valuation. They're saying the stock is 89% undervalued. 3 analysts priced this stock and the average price target was 89 cents. There was a ton of hype around this stock when it started trading. You can see it was over $13 a share. And then it came way down, really, really low. But then there was a short squeeze. A bunch of Reddit investors pumped up this stock and the stock price got really high. I think close to $4 it looks. When most stocks come up really fast, they usually go down just as fast. It has come down a ton since that big pump. There could be more downside. It's really hard to tell. They're not profitable, they're not bringing in positive cash flow, and their revenue is going down. I know they're acquiring other companies and they have lots of cash from the dilution, but the key to any business is revenue and profits. There's really nothing else. And they have a crazy high beta, close to 6, so the stock is extremely volatile. It moves 6 times the market. It's gone up 82% in the past 52 weeks, while the S&P is up 29%. The 52-week low was 30 cents. The high was $4. And the stock is trading below its 50-day and 200-day moving average. This is an extremely popular stock. Over 200 million shares are traded on average the past 10 days. All the shares outstanding are on float. 5% are held by institutions, and it has a really high short percentage. Over 14% of the shares are shorted. Even though the stock price is really low, this implies a lot of people think this company will go bankrupt. Their employee count jumped up a lot, almost 1,000 in the beginning of 2020. Then COVID hit and they had to do a lot of layoffs. Now it's back down to about 400 employees. If you put $10,000 into this company when it started trading, you'd be down to $650 today. That's a 93% loss. The biggest shareholder is Susquehanna at 1%, then Two Sigma, Murray Asset, Renaissance Technology, and Morgan Stanley. I'm surprised Morgan Stanley's invested. Usually big investment banks don't invest too much money in cannabis stocks. Let's look at their financial ratios. They have negative earnings, so we can't look at the PE. They have a really high price to sales ratio, so they're not bringing in much revenue relative to their market cap. They do have a really good price to book because they have so much cash on their balance sheet from all the capital raises. And they have 128 million of intangible assets on their balance sheet. So they have a really high current ratio of 13 and a high quick ratio of 13. They have a ton of cash on their balance sheet, over 600 million Canadian dollars, 119 million of marketable securities, and 36 million of inventory. They are well capitalized. Even though they had negative 139 million of free cash flow in the trailing 12 months, they do have 620 million of working capital. Working capital is current assets minus current liabilities. So they are funded for the next few years, so they shouldn't need to raise more equity. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 20 companies in the same industry as Sundial, and this is the average of all 20 companies. And Sundial, we can't look at their PE. They're doing much worse in price to sales, a lot better in price to book. They have a really high current ratio, a negative ROE, although the average in the industry is negative. They're really low in debt, and their market cap is smaller than average. Here's the market cap of all the cannabis companies I did a video on. There are a lot of cannabis companies larger than them, so we'll see how they navigate in this space. So to summarize, I have them trading at a 45% discount, and there's been a ton of hype around this company. It does seem like they're doing a good job at trying to grow their brand, but it is a really tough space to operate in. A lot of investors will not buy cannabis stocks, and a lot of people just don't like cannabis. Similar to alcohol, tobacco, and gambling. So those stocks have a little more difficulty than a normal stock does. And most of these cannabis companies aren't making any money yet. They're still losing money. I know it does take time, but it's not a good sign to see their revenue going down each year. But I do understand COVID happened and it put a monkey wrench into a lot of businesses. I rank their free cash flow as 1 out of 10, their revenue 2 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.